G'day and welcome to Property Australia's favourite obsession. My name's Jeremy Cownan and this is another Quickhits episode. I'll be back next week with another intriguing full episode, another interview. But today we're here to talk about building a passive income property portfolio, and who better to do that with than our in-house financial advisor Dane Pymble. Welcome to Property Australia's favourite obsession.
Jeremy, hi, how are you?
It's good to have you along, Dane.
Yeah, really good. Thanks for having me.
Now, let's start off, Dane, building a passive income property portfolio. So why property? Why would we use property as the vehicle to fund our passive income lifestyle?
Yeah, sure. So obviously it's not the only way that you can do it. It's the way that I think is certainly the most efficient in being able to build that asset base as quickly as possible. And the other point I want to make there is we're specifically talking about capital city residential property here, and not to say that other types of assets aren't relevant, just in terms of setting the goal of building that portfolio to fund your lifestyle. I think that resi property is the most efficient and sort of sensible way to do that.
So it's interesting that you started there straight off the bat with goals, because that's where we always should start, is working out what our goals are and working backwards from those goals as to what we need to do to achieve them.
Yeah, because I mean, it understanding the purpose of why you're building this portfolio is going to help really keep you focused on that long-term strategy, rather than sort of trying it out, seeing if it works, and then jumping and doing something else. This is a multi-decade strategy. And I think, the key goal really with this portfolio is understanding what to you is a comfortable lifestyle, and ideally having this property portfolio fund it. Now, that's going to be a very different number for a range of different listeners. It's really dependent on the type of lifestyle that you want to live. Do you enjoy traveling? Do you live in a higher cost area, or do you live in a regional area? There's going to be a lot of different factors that determine that. But one of the key, before you make any decision, before you buy your first investment property, you should know that the purpose that you're doing that for. And when I sit down with clients at a starting point, we often work out what that number is and then set that as the goal for the portfolio.
Interesting point, because so often people just start, they know they wanted to create some wealth, they just buy property and off they go, and they just start to build some wealth, but don't really think about the why and the how. It's interesting that you're very specific there about working out what that number is and working backwards. So let's assume you've sat down with a client and they've given you a number, whatever it happens to be. That's the income that they want to live off each year. Now what do we do?
Yeah, sure. So we can use round numbers here for the example. So let's just say that the magic number is 100,000 a year. Can be more, can be less, but for the purpose of this example, we use 100,000. So we use the 5% rule, and basically what that means is that the size of the portfolio that you're aiming to build and the income that you're looking to draw out of it, that income should be no more than 5% of the total value of that portfolio. So in the $100,000 example, the goal for that strategy is to build a property portfolio to a minimum $2 million. Now, the other key point with that is that 5% is not all pure income, as in the rental income from the properties. It's a combination of the income and capital growth that you get from that portfolio along the way. And in the phase where you're accumulating that portfolio, it's really important when you commit to this strategy that it's funds that you're not going to need to dip into and draw from to fund your lifestyle. Really important to have those cash buffers in place first, because as you would understand, that residential property is somewhat illiquid. It's not something, if you can't sort of sell it the next day to take some of that capital growth out easily. And so it might be at the end, once you've built that portfolio, you might decide, okay, now the debts are paid off, I might sort of sell one or two of these properties off so I have a more diverse portfolio that I can draw from. But in that phase where you're building it, the singular focus is just focus on buying residential property, build up that asset base, pay down the debts once you've built the asset base, and then make decisions on how you want to structure the portfolio from at that point in time.
You're right with regards to that liquidity issue that property does create, that, you do need to ensure that, once you start down, and leverage is another one too, that, the illiquidity of it is important, that you've got the cash buffers around. And as you said, it's really important that if you start down a leveraged portfolio path, that you're able to sustain it. The worst thing that can happen is you have to unwind it quickly, or have to unwind it on someone else's terms for whatever reason.
Yeah, and that comes back to the things that you can control along the way as best you can, which is the discipline with your cash flows, that what you're spending is less than what you're earning, separate to that portfolio. And that's also why I like residential property, is because the banks are willing to lend 80% or even more with lenders mortgage insurance, but 80% of the value of the property. It's a great vehicle to help you build wealth quite efficiently relative to other asset classes.
Oh, and the government kicks in, and the tenant kicks in. It's got all sorts of benefits, hasn't it?
Yeah, I mean, exactly. The tax deductibility of the interest, the depreciation on the buildings, all the expenses associated with the property being tax deductible. Ideally, the types of properties that you're looking for, effectively, the rental income is covering all of those costs, and you're just allowing the capital growth to build over time to utilise that in combination with your savings to fund the all subsequent purchases after that.
The other great thing about property that's often pushed is, of course, the lower volatility. But in this case, I think something that's often overlooked is the fact that essentially the income that comes with the property, grows in value as costs of living increase.
Yeah, so the way I often like to explain this to clients is, and we've got more than 2 centuries of data to demonstrate this, that essentially your wages, your living costs will grow over time at inflation, or a slight, wages might be slightly more. Rents will rise faster than those costs, and the property values rise faster than rents. And that's no more evidence. If you sort of look at the really high value luxury areas of capital cities, the rental yields are really low because they're already well established areas, and that's demonstrated over many, many decades.
And I think it's too important to make the distinction that we're not talking about trying to buy high yield properties to generate the 5%, that the 5% can be obtained from both income and capital growth. We're talking about good quality, high growth rental properties, aren't we?
Yeah, absolutely. Definitely prefer sticking to the capital cities. The whole yield argument, I can totally understand the appeal, because it's that whole bird in the hand theory. You get the rental income coming in. Capital growth's a little bit more, you have some years really strong growth, you have some years where you might go backwards, and you can have long periods where you're going sideways. And that's why I keep coming back to this is a multi-decade strategy. So in the long run, most of the wealth creation is going to come from the capital growth, and the key to it's really striking that right balance. You want to stay in the game, so you need enough income to service the debts along the way. But typically the trade-off is the higher the yield, the lower the growth prospects for that property.
And as you said, the higher growth properties will always win over the long run because you're comparing simple interest with compound interest.
Absolutely. Yeah. Yeah. We try and sort of demonstrate that in the advice that rental income in a lower yielding property might start off lower year one, but if you compound that over 10, 15 years, because of the growth in that rent is likely to be higher than the higher yield property, you end up with a lot more rent cumulatively over that period of time in the growth property. You just need to wait a few years for that to really start to ramp up.
Mm, mm. And I love the fact too that almost by definition, people tend to take a much longer term view of property than what they do other asset classes, which is exactly as you said. It's got to be a multi-decade approach.
Particularly with the leverage part, at its simplest form, it's a forced savings vehicle. But also, you're exactly right in the sense that, unlike shares and ETFs and whatnot, that you're getting intraday, daily pricing, and you're seeing that volatility day in, day out. Really, the only time, other than sort of comparable sales in your area, the only time your property changes value is when you buy and sell it. But you're not getting that. There is rises and falls in capital values of property over time, but it's certainly not as dramatic as what people experience with shares. And it just finds that's also the reason why I find it's the right asset class for lifestyle funding. So that it's effectively so you can sleep at night, and once you've built this portfolio, you can choose whether you want to keep working or not. But you don't want that sort of portfolio being too speculative, because you don't want to be reliant on speculative assets to be funding your lifestyle.
So Dane, who can do this?
A lot more people than many realise. I think the hardest, and in some ways it's sort of linked to the question as to how you get started. The hardest thing with this is the first step, which is coming up with a deposit for the first property. And that really comes, it's basically, to answer your question, anyone can do this that is able to save money consistently. I'm not saying all elements of society are capable of doing that, but if you've got the capacity to save whatever it happens to be, but you can do it consistently, then once you've built that first deposit, that gets you started.
You're absolutely right with regard to it. All comes down to cash flow management, doesn't it? You don't have to be a high income earner. You just have to be able to control your cash flow. You just have to be able to spend less than you earn. You just need to be able to save something. And if you can save something, then the idea is that you build for a deposit. And once you get a foot in, as the properties grow, then you just use the increased in equity to help continue to fund further purchases.
Yeah, you're very right. And it has well, I shouldn't say it has nothing. It has very little to do with how much you're earning. It really does come down to your cash flow habits. And when I'm advising clients, I'm not really the type of advisor that will sort of say you really need to rein in your spending. It's more sort of try and explain to them, okay, well, you choose the lifestyle that you want to live. Here's what you've said that you want to get to. Here's what you need to do to get there. And then you give a bit of personal responsibility to the client to decide, well, do I want to rein back some of this spending because that'll allow me to get to that point quicker? Or am I happy for this just to run its course and enjoy the lifestyle that I have now? Everyone's going to be different. Everyone's earning different incomes, but also everyone's living different lifestyles.
And yes, you're absolutely right. And it really just comes down to, as you said, just being able to control your cash flow. If you can do that, then you can get a start and off you go. And for those people that are struggling to make a start, we did talk in episode 16 of our Quickhits about family pledge loans as well.
Yeah, that's a really great product. And, not everyone's going to be able to access it, but like I said, the hardest thing really for most people is getting that first deposit. If you're in a position where you're consistently being able to save money, but you haven't yet built that whole deposit, provided your parents are willing to support you, that family pledge loan can work really well, because rather than having to guarantor the loan in its entirety, really they're only guarantoring the gap in the deposit that you need to come up with. And so it really minimizes the risk for them. But I only ever advise, like when I'm advising clients on this, I make sure that the children, or the adult children, have demonstrated to themselves, let alone to their parents, that they are disciplined in their saving before we go to that step. But if they've done that, then it removes the biggest barrier for a lot of people. That if your parents have already built significant equity in their property or properties, then that gets you started. And then once you've built, let's say, once you've built 20% equity in that first property, you can then take your parents off the loan. They're no longer having to guarantor it, and you start building towards that next purchase.
Yeah. One of the things that I really like about the concept of using property to fund your lifestyle, moving forward is, the bottom line is nobody knows how long you're going to live, and that whole idea of having indexed income, I think is really important, isn't it, Dane?
Yeah, it is. And it makes property such a great vehicle for this, because in the first phase where you're using leverage to accumulate that wealth, well, there's some great tax advantages with doing that. But it also still works really well once those debts are paid off. Like you said, that the income that's linked to to property through the rental income is typically rising faster than your living costs are.
And with a with this sort of strategy, Dane, what happens to the excess capital? I mean, the 5%, if we've still got the properties growing, we're only taking out 5%, we'd expect a return greater than 5% over the long term. So the expectation, I guess, is that the bulk of the assets will be in place upon death. So, what's the idea? Leave it as a legacy to your family, or?
Yeah, I mean, there's a whole range of different things, and that's a very individual choice, and it's a key part of the discussion that we have with clients at the starting point. I always try and encourage, because every parent wants to help their child, but sometimes that comes at the expense of their own lifestyle. So I think it's really important to look after yourself first to be able to help others. I think that's a really key thing. But once you're in that position that you describe, you do have those options, and so it can be leaving a legacy for your children or society in general. It could be that the goal is to fund a sustainable lifestyle, but there might be things that you want to do that you kind of left out of that goal. Building a larger portfolio is obviously going to be able to fund a more extravagant lifestyle, and there's nothing wrong with that if you've done the work to build that sustainable asset base to fund it.
Is there anything else that you'd like to add?
I mean, I think it comes back to that point that often when people are considering investing in property, and obviously people listening to this podcast, they're either already investing in property or considering it. A lot of the enthusiasm and the focus is around the investment themselves, and the strategy kind of gets put to the side. It's like, it's kind of, society tells me I'm supposed to build wealth. Society tells me I'm supposed to, consider investing in property. But that's understanding why, the purpose of why you're doing it is the most important bit. And it's all you need to focus on. Because once you've made your investment decision each time, you then go back to living your life, and the way we do it, we do an annual review of has there been any major changes? Do we need to make any tweaks? No. Okay. Are you in a position to consider another purchase? Yes. All right. Let's do that. And I think it is a very simple strategy, but it's made overly complicated by the amount of noise that exists around. Everyone's going to have an opinion on what you should buy, where you should buy, how much, when. Should it be crypto? Should it be property shares or whatever? And I'm not saying I'm an evangelist for property only. It's just for this particular purpose, it works really well. But as you know, we invest in a range of different asset classes. But for this specific goal, capital city residential property works really well to build that portfolio sustainably, funding your lifestyle.
I couldn't agree more, and I completely agree that the noise is what makes it so difficult. It's the emotion, and it's the fact that people don't think about what the goals are, and they don't stick to the plan, and so they get sidetracked, and inevitably those sidetracks are very costly in both monetary and in time.
Yeah, and I think one other last point is that patience. Like you just mentioned, that because the enthusiasm, you're looking for that sort of validation as quickly as possible that you've made the right decision. Sometimes it just doesn't work out in the short term, but you look back through two centuries or more of history, property's done reasonably well over the long run. You just need to give it its time to do its job.
And it's a sad fact that most investors only hold investment properties for 2 to 3 years. By the third year, most have tipped them out, gone elsewhere, which is a real shame because you're not giving the asset class a chance to do its work.
Absolutely, it can be a number of years where it doesn't feel like much is happening, and then it'll go on quite a burst for a few years as well. And you look at the capital city markets. Let's take Sydney, for example. Between 2004 and 2012, Sydney didn't really go anywhere. And then, you talk to people considering a Sydney property investment in 2012, very different discussion to where we're sitting now, where it's kind of the opposite.
Yeah.
And it's probably now that's the time that other capital cities might be more relevant.
All right, Dane. Well, it's been a pleasure talking to you. Let's wrap it up there. If listeners want to get in touch to discuss their financial needs, where do they go?
Yeah, sure. So, callanflack.com. You can find my bio on there. Email address dane.pymble@callanflack.com.
Well, definitely look him up if you want to have a chat. Dane, thanks again for spending some time with us. Do appreciate it.
You're welcome, Jeremy. Thanks for having me.
And thanks, of course, to all our listeners. We do appreciate you joining us once again. If you want to catch up, then stop on by at pafo.com.au. Of course, PAFO is the acronym for Property Australia's favourite obsession, and that's also our social media handle, so it's PAFO Pod. You'll find us there on Facebook, Instagram, and on Twitter, or you can drop me a direct email at jeremy@pafo.com.au. I do ask if you have enjoyed today's episode, then please like, subscribe, and leave us a rating or review because it does help others find our show. I've been your host, Jeremy Cowden, and you've been listening, of course, to Property Australia's favourite obsession. And until next time, Dane, let's keep obsessing about property.
Absolutely.
Any opinions or recommendations expressed should be considered general in nature, as they do not consider your personal objectives or financial circumstances. You should therefore consider these matters yourself before deciding whether the advice is appropriate to you and if you should act upon it. Should advice be sought, please seek an appropriately qualified advisor. Investing may not be appropriate for everyone, as there is inherent risk and the possibility of loss when investing in financial assets, just as there is the possibility of profits. While useful for identifying patterns, history and past performance do not guarantee future performance. Callan & Flack has a commercial relationship with guests appearing on this production.